Speaker of the House Nancy Pelosi touches down in Taiwan. The reaction out of China was predictable. Within minutes, they sent jet fighters over the Taiwan Strait and announced they would hold live fire exercises around the island. What's next for China and the United States now that we're at DEFCON 1? Welcome to the Money Runner. I'm David Nelson. The rhetoric surrounding Taiwan and China's intention to retake the island, that's been a threat for decades, and we shouldn't be surprised by the reaction. Once the speaker announced she was going, there really was no other option but to carry it out. Anything else would have been viewed as a sign of weakness. Typically, the knee-jerk reaction surrounding a geopolitical event like this is for stocks to get hit hard and then recover slowly as the news proves better than feared. That certainly didn't happen this time. Stocks paused for a day and then took off. The risk of Taiwan spinning out of control becomes even more of an issue now that China has a military that can back up its threats. The question for experts is, will they risk it in their current weakened economic position, or wait for a better opportunity regardless of how provocative they feel this current visit is? All of this points to the need of onshoring our manufacturing back here in the United States. We've talked about it on previous pods, but as much as I don't like the current semiconductor bill, leaving our manufacturing footprint in Taiwan is a risk we can't afford. Look at this list of the customers of Taiwan Semiconductor: Apple, Qualcomm, Intel, Advanced Micro, NVIDIA, the list goes on and on. Their customers include any industry that uses chips. That's just about everything from your refrigerator to your iPhone to your SUV. Bringing it back to the United States has become a national security imperative. Of course, China and Taiwan aren't the only news shaping the markets of late. Back here in the States, the administration, the press, and some leading economists are having trouble with the term recession and its definition. So much so that it's actually sparked a raging political debate with each side accusing the other of misleading the American people. It doesn't matter what talking heads think, including me. The American people already have made that decision. Most polls show the majority of Americans believe we're in recession. It matters because it influences future behavior, and that's exactly what the Federal Reserve wants. The Fed would much prefer that demand slows, letting supply chains catch up, making their job that much easier. Instead of living in denial, own it. A better approach would be to point out that the slowdown is on the heels of unsustainable growth last year post the COVID recovery. We've had back-to-back quarters of negative GDP, two back-to-back quarters of negative GDP growth, in part because of the efforts of the FOMC to bring down inflation expectations. Consumer inflation right now is at 40-year highs, and on Friday, we got confirmation that there's still a lot of work to do. The PCE price index, that came in at 6.7% year on year, followed by federal spending, personal spending for June up 1.1%, and the employment cost index up 1.3%. All of these were hotter than expected. Fixed income markets spell out recession in the form of an inverted yield curve. The spread between 2-year and 10-year yields is now at minus 36 basis points. I guess when you think about it, the reason the administration and some of their economists are so adamant about redefining the term recession is that for most Americans, when you mention that word, they think of 2008 and the financial crisis. What you and I are going through today is nothing like that. And I grant you, I take it to heart. I understand that what we're going through is pretty severe, but 2008, that was a credit event. Our financial institutions were very close to insolvency. Today, stocks are looking right through this economic data. Stocks sniffed at a recession early in the year and priced it in very quickly. And already, at least for the moment, these stocks are looking through current conditions to the other side of the valley. We saw that in last week's reports from big tech. Apple reported an 11% decline in profits. Microsoft missed on every line item, and Amazon reported a $2 billion loss, yet all of these stocks pushed higher because they're looking through to the other side. After drifting lower for a couple of days, stocks today picked up right where July left off. Look, I'm not blind to the challenges in front of us. The Fed still has a monster job to do in getting inflation expectations lower. And the jobs market is not as healthy as it was at the start of the year. Several companies, including big tech companies like Apple, Microsoft, and Alphabet, they've all announced a cutback in hiring. But stocks are a discounting mechanism. They don't look backwards, they look forward. And right now, the charts are saying that the offense is on the field. The fundamentals, I grant you, they're saying something else. But look at this chart of the NASDAQ. The NASDAQ is up just shy of 19% off the lows of June. Once it hits 20%, it actually meets the definition of a bull market. The break in the downtrend for the S&P is still holding, and that's pushing higher as well. Until proven wrong, we really have to try to catch as much of this rally as we can, as long as the price momentum is with us. Let's see what Friday's job numbers have in store. Unemployment claims have been rising for months, and some of the largest companies on the planet seem to be pulling back. The street right now is looking for a pretty hefty print. 275,000 jobs are the expectations for July. For now, I'm going to take the under on that number. I know we covered a lot of ground today, but don't forget, every morning we post the Market Minute. It's quick, to the point, and just the information you need to start your day. I'll see you in the morning and, of course, next week on the pod. Thanks for joining. I'm David Nelson.